This is our Forex blog for August 25th, 2011. If you've watched some of our other older Forex blogs, you'll notice that previous to today and yesterday, and I believe the day before, we had, on most currencies, there were a lot of instances where a currency would hit plus 80, and then minus 80, plus 80, and so forth. Now it happens much less often, and so when a currency does hit the plus or minus 80 level, like right here with the yen, it became the weakest of all the currencies. The intermediate time frame trend is down, daily trend down, weekly trend down. Unfortunately, the monthly trend's up, but who cares what the monthly trend is? All we care about really is where it goes for the next half hour to 3 hours. So at 1 o'clock, the yen was the weakest one. The euro was consistently one of the strongest, slightly after 1. We had mild strength in the CAD. The pound at that point had some decent strength. However, the daily and weekly trend is down, so you're less likely to make money, or I should say a lot of pips, more than 30 in the pound yen, because you're going against the longer term trend with the pound. But the euro is pretty much a no-brainer. So what you want to do is buy the super strong euro against the super weak yen. And one of the best ways of doing that is using a range bar chart. We'll put the euro yen in here. Let's put a 6 pips per bar on here, and this basically is going to every time the price moves 6 pips, create a new bar. And this is approximately what the volatility is on this one. So at 1 o'clock, you're basically looking to buy the super strong euro versus the super weak yen, and 1 o'clock's right here. So it hadn't even broken out yet. So even if you didn't get into this trade until somewhere in this area, or you got into it when it broke out of this nice little range, these are two patterns that oftentimes happen on pips per bar charts. You have a nice, even if you got into it extremely late, you have a beautiful 60 pip move. And if you miss this trade right here, one of our entries when you have a strong trend is whenever the market makes a pullback of 2 to 5 bars, the first green bar you go long. I personally wait for it to go a pip above the bar's high right here. I'd be in at 111.22 or so, and you're in with your stop a pip to 3 pips underneath the low, and you have your profit target set ahead of time up here. And even if you got out of this trade at 45, made 25 pips while risking about 10, that's 2.5 times bigger profit than your risk, and that's really the only key to trading. So again, the euro was the strongest, the yen was the weakest, and up until about 340 here, it had some strength, and then some weakness came back in a little bit after 4. Unfortunately, the euro's strength kind of became weakness right then, but the Swiss had gone strong a little bit before that. You could have, coming up to 4 o'clock, been looking to buy the Swiss yen. Alright, so as I said, coming up to 4 o'clock, the Swiss started getting strong. The yen was consistently weak. You have this nice little breakout. If you miss that trade, you also have this nice little wedge pattern right here. And it only went up about 15 pips. And then at 5, the Swiss, unfortunately, got weak. Had about a half an hour strength and has been weak ever since. The yen, also after 7, lost its extreme weakness. Another currency that was pretty strong today was in New Zealand on all time frames for the most part, except the monthly. New Zealand yen after about 130, also a very high odds trade. And if you're a U.S. trader, we'll show some examples of the U.S. Here's 1 o'clock, somewhere in here. It breaks out of this nice little range. Again, you already have your Fibonacci profit target set ahead of time. And it went right up to that level in reverse. So you're never ever going to catch every pip, but let's say you get out right here 64.05, you bought it around here, you got about 18 pips while risking 10. And because it made a higher high and you got this nice pullback, you got this nice little wick at the bottom, you might have went long right here, and this trade really didn't pan out. But once the currency goes a bar or two your favor, at the very minimum move your stop to break even, or let's say you lost 3 pips on this trade, that's fine. But you don't ever, you rarely get hurt when you're trading one strong pair versus the other one. They don't always work out or give you 30 to 50 pip wins. This trade here is only about 18. This one you had an opportunity to make, 7 to 10 pips. And then you have this nice little pullback trend here. Because it didn't break the low, the second trade worked. You can see it went from 90 all the way to 20, up 30 pips. And whether you got out of half your trade here when it went red, or you put your stop underneath that bar's low by a pip or two, you might have got out of this trade a little bit before 64.10. You still made 17 pips on that trade. Later in the day, we have extreme strength in the CAD at 8:30. Because of the new weightings, you're going to see a lot fewer plus 80 or minus 80 readings. And when you do, and when it matches up with the intermediate and hopefully the daily and hopefully the weekly and hopefully the monthly, I only care about the real time and the intermediate for the most part. If the daily and weekly is up, that just increases the odds of the trade by 5 or 10% in my opinion. So this was very strong at 8:30, but the yen's no longer weak, and neither is the dollar. But guess what? The pound is. A little bit after that, probably at 8.50, the pound's weak. So the pound CAD after 8.50 is a very high odds trade. The euro was looking weak at that point. Now in real time it had some strength coming in there, but the intermediate time frame trend was down. I probably would have personally avoided the euro just because all the other time frame trends were up. The Swiss was down on all time frames. That's probably the highest odds one except for the monthly here. So the highest odds one with the CAD was the Swiss. Pretty much a no-brainer. And when you're watching it live, it's much easier to see what's the current right-hand side strongest one. CAD strong, Swiss weak, going up a little bit before 9 o'clock, 8:30 or so. Strong CAD, weak Swiss, and let's see, 8:30. 8:30 is right here. We got a little bit of a pullback, and if you're watching this currency, you might have got into that trade. That's not a very good trend line there. Redraw this here. But basically, when it breaks out above that 3-bar pullback, you go long with your stop right underneath the low, and it just takes off. And if you're a little bit more cautious, I personally don't like to buy breakouts when I can get a nice pullback like this. I can risk 5 pips and lose 10 to 12 or 13 pips one time versus buying a breakout. You need to have a much wider stop, and then at that point you have the Fibonacci profit target level off the first wave up. This is a good place to get out of your trade, and even if you got out of it right near the first level at 87 here and you got into the trade late, you made 25 pips. If you would have bought it down here, you made another 10. So 35 pip win, risking 7 or 8. And there's some other trades that you might have taken. You might have seen this nice little sideways rectangle pattern, which oftentimes works with your stop underneath here. Starts to go up, kind of runs out of steam. There's a little wick on that bar, a red bar. At the very least, you should move your stop up, or you might have lost 5 pips there. Pull back and didn't significantly go underneath the low. But when it breaks out here, that's another no-brainer trade. And you put your fibs on here, and again out somewhere around 20. That's a 40 pip move. Using the currency meter to focus on the highest odds trades. Now there was about a half an hour of weakness there going into 10, and then the CAD became strong again. Now at 10 o'clock, this one's not as weak as it was before, but let's look at the chart going into 10. Got a little bit of a pullback. Here's 10. Let's say you bought this breakout right here. If you just started trading here, you might start the day with a loss. You wait for the next pullback, starts consolidating. You might have went long right here. Watching your stop underneath here, kind of just barely goes your way and come back. You want to tighten your stop. That trade really didn't pan out to anything, but you can see you quickly moved your stop up there, and then watching the currency meter coming up towards 11. You can see that there was just simply no weakness in the Swiss. You probably wouldn't have even been in this one. You would have probably traded the CAD against a weaker pound. Pound's CAD going up towards 11 is very likely to have fallen, and you would have been looking for sells in this. Notice earlier the trend that occurred when you had a super weak pound and a super strong CAD. This is astronomically huge move, over 100 pips. And then you have a nice little rectangle pattern right here. You're trading one of the weakest pairs, the pound, versus one of the stronger ones, the CAD. And you can see it came down another 35-40 pips, pretty much straight down. Later in the day also, the dollar got pretty strong here at 10. and the weakest one around that time was the euro and the pound. The pound has the benefit of the daily, weekly trend being down, so I would prefer personally to look for pound dollar sells coming up to 10, 930, 10. And even earlier, when you had strength in the dollar, and then this one became extremely weak at 9, you really could start looking for pound dollar sells at 9. So here's 9. You had a little bit of a pullback because the dollar was weaker at that time than the pound, but it did have some pretty extreme strength earlier and earlier. So when you had this nice little double top here, you might have just kind of anticipated the trend breaking. Once it does break the low, usually you're pretty safe in selling that, and you would move your stop here. When it kind of consolidates here and doesn't break down, you want to move your stop down. You lose 6-7 pips here. You go short the second time, and you can see it just takes off. And when you're in one of these super strong pairs like this, I don't like to sell, or I should say I previously didn't like to sell the lows like this. I'd like to wait for a 10 to 25 pip pullback before getting into the trade. When you're in the weakest versus one of the strongest, look at this extreme strength right here, even at 1030. You really have no choice but to take these trades now. You're risking 10 pips, and if the trade works, and it's probably 70% likely in my opinion, it's going to, at the minimum, go to the first fib target. It's so weak that it went past that and even past the second fib target down here. But let's say you get out of this trade at 80, you short around 05, you made 25 pips on this while risking 10. So basically, every 2 winning trades you make like this, you've netted 50 pips. If you lose 10 pips 5 other times, you're break even. 5 out of 7 trades can lose with these kind of odds and type of volatility moves, and you can break even. So obviously it makes it a lot easier to make money because you're probably not going to lose 5 times for every 2 wins using this. As you can see today, it pretty much works every time. Some of the time you only make 5, 6, 7 pips, or it moves up 10 pips, so you move your stop in half and you only lose 5 versus the 10. You rarely lose your entire amount. Let's look at the euro too. This became pretty weak right here at 9.45. At 9.45 the dollar was kind of weak. The yen was stronger of the two. And soon after that the dollar became strong, and you might have looked for a euro dollar sell before that. But let's look at the euro yen sell coming up to around 9.30. Alright, here's 9.30. You know that the euro is starting to go through some weakness, and the yen was moderately strong before that. So basically there's a nice little trend line pullback. The fact that it didn't break out over the previous swing also adds to your odds. And if you miss that trade there, I wouldn't have bought this one at the low. But once it breaks the low and pulls back a little bit, it becomes pretty safe to sell the first bar. Notice this is exactly what I'm talking about with a 3 to 5 bar range bar counter trend move. First bar red, wait for it to go 1 pip below that. You're literally risking whatever the size of the bar is plus 1 to 3 pips. And unfortunately this didn't go to where the fib target was, but it did chop around here. Anytime you see this, it's not a good sign for your trend trade. Trends should really just go straight, pull back straight, or trend, sideways. So when you get this, get out of the trade. And let's assume you got out at 111, which probably would have been the worst you did. You made 12 pips on this while risking 6 plus, let's say, 3 pips padded, 9 pips. Still, your wins are bigger than your losses, even on a trade like this that didn't, really pan out. We know that the dollar became a lot stronger than the yen. And let's say you didn't really start looking for some euro dollar sells until after 10. Because before 10, the yen was stronger than the dollar. So here's 10 o'clock. It slightly broke the low here. And anytime you get a double bottom that doesn't cause the counter trend move up, that's a pretty good odds for your trade and your short. This is exactly like what I talked about before. A good trade will either go, counter trend go, or go, better yet, go sideways and go. And so don't get greedy. If you're in this trade, draw your fibs whenever you see a rectangle pattern like that, and get out this fib target down here near 30. But that's a 70 pip move. So you're going to catch some, you're going to miss some and kick yourself, but as you can see, there's a good chance of catching 20-30 pips as long as your losses are small if you lose 10 pips and you catch one 10 or 20 pips and catch one nice 30 pip move or two 15 pip moves, you still netted 10 pips on the day.